New York City, December 10, 2008, 6:30 p.m. Inside a $7 million Manhattan penthouse, Bernie Madoff closed the apartment door and looked at his two sons. For nearly 40 years, the world believed he was one of the greatest investors alive. Banks trusted him, billionaires admired him, charities depended on him. Even Wall Street treated him like royalty. Then he quietly said words that would destroy thousands of lives. The business is one big lie. Within 24 hours, the largest investment fraud in history would begin collapsing. Imagine opening your investment account tomorrow morning. Yesterday, it showed $8 million. Today, it shows zero. Not because the stock market crashed, not because your investments failed, but because the money was never really there. That nightmare became reality for thousands of people. Some lost retirement savings. Some lost children's college funds. Some charities lost money meant for cancer research and education. And investigators soon realized something terrifying. This wasn't a mistake. It was one of the greatest financial deceptions ever created. The reported value of Bernie Madoff's client accounts reached nearly $65 billion. That's more than the yearly economy of several countries. Enough money to buy hundreds of private jets. Enough to build thousands of schools. Enough to change millions of lives. Instead, it became the symbol of the biggest Ponzi scheme in history. But here's the question that shocked investigators. How can $65 billion disappear while almost nobody notices? Here's what makes this story different. Bernie Madoff wasn't hiding in another country. He wasn't using fake identities. He wasn't running from the FBI. He worked in one of the most famous financial districts on earth. He wore tailored suits, appeared at charity events, led one of Wall Street's most respected firms. He even served as chairman of NASDAQ. If anyone looked trustworthy, it was Bernie Madoff, and that trust became his most valuable asset. Most financial scams promise impossible riches. Bernie Madoff did something smarter. He promised something people wanted even more. Consistency. Not 100% yearly returns. Not overnight wealth. Just steady profits, month after month, year after year. Even when markets crashed, that consistency made investors believe they had finally found the safest man on Wall Street. But one person looked at those perfect returns and saw something completely different. His name was Harry Markopolos. Unlike almost everyone else, Harry didn't care about Bernie's reputation. He cared about mathematics. His job was simple. Find investment strategies, test them, break them apart. When he examined Bernie's reported returns, something immediately felt wrong. Not unusual. Impossible. That discovery would start a 9-year battle against one of Wall Street's biggest secrets. Harry tried recreating Madoff's strategy again and again. Every calculation failed. The numbers refused to work. Markets simply don't produce perfect results year after year. Even Warren Buffett has losing periods. Even the world's greatest investors make mistakes. Yet Bernie Madoff somehow avoided almost every major loss. To investors, that looked like genius. To Harry, it looked like fraud. But proving it would become far harder than anyone imagined. Over the next 9 years, Harry Markopolos repeatedly warned the U.S. Securities and Exchange Commission. He sent reports, charts, mathematical evidence, detailed explanations. His message never changed. The numbers don't work. Yet every warning failed. Meanwhile, thousands of new investors kept sending Bernie Madoff their savings. Every month, billions of dollars moved into his firm. Every month, the lie became stronger. And the biggest mistake was still years away. Harry Markopolos wasn't trying to become famous. He wasn't trying to destroy Bernie Madoff. He simply wanted the truth. When he rebuilt Madoff's investment strategy using real market data, one fact became impossible to ignore. The returns should not exist. Markets don't reward investors without risk. Some months should have been negative. Some years should have been disasters. Instead, Madoff's statements looked almost perfectly smooth. Harry reached a terrifying conclusion. Either Bernie Madoff had discovered something no one else on Earth understood, or he wasn't investing the money at all. Instead of staying quiet, Harry did something very few people would do. He wrote a detailed report, not one page, not two, dozens of pages explaining exactly why Madoff's numbers violated basic financial mathematics. He sent everything to the SEC, the people whose job was protecting investors. Harry expected one thing, a serious investigation. Instead, almost nothing happened, and every month that passed made Bernie Madoff even more powerful. While regulators hesitated, investors kept arriving, not because Bernie advertised, Because existing clients did it for him. Friends invited friends. Business partners invited partners. Entire families invested together. Some wealthy investors even felt honored just to be accepted as clients. Bernie carefully created the illusion that access to his fund was exclusive. People believed they were joining a private club. They never realized they were walking into history's biggest financial trap. Money didn't always flow directly to Bernie. It often traveled through feeder funds. These investment firms collected billions from their own clients before sending that money to Madoff. One of the largest was Fairfield Greenwich Group. Investors believed professionals had already checked everything. Instead, many trusted Bernie's reputation without fully understanding his strategy. The chain looked safe. Investor, fund manager, Bernie Madoff, but one weak link was enough to destroy everyone connected to it. By 2007, Bernie Madoff wasn't managing thousands. He was reportedly managing tens of billions of dollars. His clients included successful entrepreneurs, Hollywood figures, international investors, universities, charitable foundations. Some families had trusted him for over 20 years. Every monthly statement looked normal. Every profit looked believable. And that was the genius of the fraud. Nothing looked extraordinary. Everything looked comfortably ordinary. A normal scam promises unbelievable profits. Bernie Madoff understood human psychology. He didn't promise to make people rich overnight. He promised stability. Around 10% to 12% annual returns. Just enough to sound realistic. Just enough to avoid suspicion. Ironically, those modest-looking returns became one of the biggest reasons intelligent investors trusted him. Sometimes the most dangerous lie is the one that sounds reasonable. Then, thousands of miles away, another disaster was already beginning. The American housing market started collapsing. Banks suddenly faced billions in losses. Mortgage-backed securities were failing. Within months, fear spread across global markets. Investors everywhere asked the same question: where's my money? For honest investment firms, this was a difficult period. For Bernie Madoff, it was the beginning of the end, because his business depended on something much more fragile than investments. It depended on trust. For almost 40 years, new money had quietly replaced old money. Withdrawals were paid using fresh deposits. As long as new investors kept arriving, nobody noticed. But the financial crisis changed everything. New investments slowed. Withdrawal requests exploded. According to investigators, clients soon wanted to withdraw billions of dollars. For the first time in decades, Bernie Madoff faced a problem he could no longer hide. And within weeks, the perfect lie would completely fall apart. By September 2008, the financial world was in chaos. Lehman Brothers collapsed. Banks stopped trusting each other. Stock markets crashed. Panic spread across Wall Street. Investors who once ignored risk suddenly wanted cash. Immediately, thousands called their financial advisors, asking the same question: can I withdraw my money? For most investment firms, it meant selling investments. For Bernie Madoff, it meant facing a truth he had hidden for decades. A real investment fund can survive withdrawals. It sells stocks, raises cash, pays investors. A Ponzi scheme cannot. It survives only while new money keeps arriving. Once withdrawals become larger than new deposits, the mathematics stop working. According to investigators, Madoff suddenly faced redemption requests worth billions of dollars. He didn't have the money because much of it had never been invested the way clients believed. The perfect machine had finally run out of fuel. Inside Madoff's office, everything still looked normal. Employees answered phones. Monthly statements were printed. Clients were told their portfolios were healthy. From the outside, nothing seemed unusual. But behind closed doors, panic was growing. Every withdrawal request made the hole even bigger. Every passing day reduced the chance of survival. For nearly 40 years, confidence had protected the scheme. Now fear was destroying it. On the evening of December 10, 2008, Bernie Madoff made the decision he had avoided for decades. He called his sons, Mark and Andrew, into his Manhattan apartment. What he said lasted only a few moments, but it destroyed 40 years of lies. According to court records, he admitted the investment business was one big lie and described it as basically a giant Ponzi scheme. The secret was finally out. The next decision belonged to his sons. Mark and Andrew faced an impossible choice: protect their father or protect thousands of innocent investors. Within hours, they contacted their lawyer. The lawyer contacted federal authorities. The chain moved quickly. The fall following morning, December 11th, 2008, FBI agents arrived at Bernie Madoff's apartment. One of the most respected names on Wall Street was placed under arrest. The man who had fooled the financial world didn't run. He quietly surrendered. The news exploded across the globe. Television networks interrupted regular programming. Financial websites crashed under heavy traffic. Thousands of investors rushed to check their accounts. Many believed there had to be a mistake. Others already knew the truth. Their retirement was gone. Their children's future had changed overnight. Some charities immediately suspended programs because expected funding had disappeared. The collapse wasn't just financial. It became deeply personal. As FBI agents entered Madoff's offices, investigators began collecting computers, trading records, bank statements, and client files. They expected to find evidence of one massive fraud. Instead, they uncovered something even stranger. Many of the reported trades never happened. Many account balances existed only on paper. The statements looked real. The investments often weren't. The more investigators searched, the larger the deception became. Then another disturbing question emerged. How did this survive for nearly 4 decades? Harry Markopolos had warned regulators. Analysts had questioned the numbers. Some journalists had raised concerns. Yet billions of dollars kept flowing into the scheme. The investigation was no longer just about Bernie Madoff. It had become an investigation into the failures of Wall Street itself, and following the money would reveal just how deep those failures really were. Once Bernie Madoff was arrested, investigators faced a question bigger than the fraud itself. Where did the money go? Clients believed their savings had been invested in stocks. Statements showed years of profitable trades, but investigators soon discovered a shocking reality. Many of those trades had never happened. The profits existed on paper, not in the market. The hunt had changed. It was no longer about proving fraud. It was about finding billions of missing dollars. Investigators began tracing money one transfer at a time. Bank records, wire transfers, client deposits, withdrawal payments. Every document became another clue. Slowly, a simple pattern appeared. New investors deposited money. Older investors received withdrawals. Monthly statements created confidence. That confidence attracted even more investors. The cycle repeated for decades. The money wasn't creating wealth. It was simply moving from one pocket to another. The fraud survived because it looked ordinary. Clients received statements every month. Balances steadily increased. Some investors successfully withdrew millions of dollars. That convinced everyone else the system worked. Ironically, successful withdrawals became the strongest advertisement for the scheme. People assumed, if my friend received his money, mine must be safe too. Trust created more trust, and that trust quietly funded the next payment. The investigation also exposed a major regulatory failure. Harry Markopolos had repeatedly warned the SEC beginning in 2000. He submitted detailed mathematical analysis. He explained why the reported returns were statistically implausible, yet meaningful action never followed. After the collapse, the SEC publicly acknowledged mistakes in its oversight. For many Americans, this raised another disturbing question. If regulators missed this, what else could they be missing today? Then came the human stories. A retired couple lost the savings they had built over 40 years. A charitable foundation suddenly couldn't fund scholarships. Families delayed retirement. Some people returned to work in their 70s. Money represented much more than numbers on a statement. It represented security, education, healthcare, a lifetime of planning. When the fraud collapsed, it didn't just erase bank balances. It erased decades of confidence. Meanwhile, prosecutors built an overwhelming case. Financial records, employee testimony, bank documents, client statements, confession. Every new piece of evidence confirmed the same conclusion. This wasn't a failed investment strategy. It wasn't bad luck. It wasn't poor risk management. It was deliberate deception. The evidence ladder was complete. Suspicion had become proof. In March 2009, Bernie Madoff officially pleaded guilty to 11 federal felony charges. There was no dramatic courtroom battle, no lengthy denial. The evidence spoke for itself. 3 months later, a federal judge sentenced him to 150 years in prison. It became one of the harshest financial crime sentences in American history. For victims, justice mattered. But justice could never replace lost time or lost trust. The conviction answered one question: who committed the fraud? But another question remained unanswered. Could any of the money still be recovered? Billions of dollars had disappeared through decades of deposits, withdrawals, and transfers, finding that money would become one of the largest financial recovery operations ever attempted. And, surprisingly, investigators were about to recover far more than almost anyone expected. The day Bernie Madoff went to prison, the fraud officially ended, but the damage didn't. A federal court appointed Irving Picard to recover whatever money remained. His job sounded simple: find the missing billions. Reality was very different. The money had been moving for decades, across thousands of accounts, through banks, investment firms, feeder funds, and international transfers. Finding it would become one of the most complicated financial investigations ever conducted. Picard's team followed every clue. One bank transfer led to another. One payment revealed another account. Every recovered dollar represented months of legal work. Some investors had unknowingly withdrawn more than they originally invested. Courts ordered many of those profits returned so victims could receive fair compensation. It wasn't about punishment. It was about rebuilding lives. And slowly, the money started coming back. By 2026, more than $14 billion had been recovered or committed for distribution to victims. That makes the Madoff recovery one of the largest financial asset recovery efforts in history. But here's the heartbreaking reality. Even billions of recovered dollars couldn't replace lost time. People who planned peaceful retirements never got those years back. Families rebuilt their finances. Trust was much harder to rebuild. The scandal changed Wall Street forever. The SEC admitted serious failures. Internal investigations revealed missed warning signs. Financial oversight became stricter. Investment firms strengthened compliance procedures. Universities began teaching the Madoff case to future bankers and regulators. One fraud reshaped an entire industry, not because it introduced a new scam, but because it exposed old weaknesses everyone believed had already been solved. Bernie Madoff died in federal prison on April 14, 2021, at the age of 82. His death closed the legal story. It did not close the human story. Many victims were still rebuilding. Recovery efforts continued. Court cases continued. For millions of people around the world, his name stopped meaning one person. It became a warning, a reminder that trust can be more valuable and more dangerous than money itself. Looking back, Bernie Madoff didn't beat Wall Street because he was smarter than everyone else. He won because people stopped asking difficult questions. Investors trusted reputation. Banks trusted reputation. Fund managers trusted reputation. Regulators trusted reputation. One assumption led to another. One decision led to another. And together, those decisions protected a fraud for nearly 4 decades. History shows this pattern again and again. The names change. The companies change. The countries change. But human behavior rarely changes. Greed creates opportunity. Fear creates panic. Trust creates comfort. And comfort often silences skepticism. The biggest financial disasters usually don't begin with obvious criminals. They begin with believable stories. That is exactly what made Bernie Madoff so dangerous. So after everything we've uncovered, one question still remains. If the largest Ponzi scheme in history could survive for nearly 40 years, if billions of dollars could disappear inside one of the world's most sophisticated financial systems, if respected investors, banks, auditors, and regulators could all miss the same warning signs, then what company, investment, or safe opportunity are millions of people trusting today that future generations may one day study as the next Bernie Madoff? Because history has a habit of repeating itself. The only difference is the name.